In this screencast, we'll talk about monetary policy in a limited reserves framework. We'll look at the three tools of monetary policy and the impacts from them of expansionary and contractionary monetary policy. We'll also look at the money market graph, the loanable funds graph, and the ADAS model as we go through examples of expansionary and contractionary monetary policy. There are three tools of monetary policy in a limited reserves framework. A limited reserves framework is when the central bank is setting a reserve requirement. And so there's a limited amount of reserves. They're not abundant. Banks are fully loaning out their excess reserves in a limited reserves framework. For AP exam purposes, when the exam questions talk about the Federal Reserve Bank of the United States, they're talking about an ample reserves framework because that's currently how we are operating. But if any other bank is given that's not the Federal Reserve of the United States, if it's any other type of central bank, just assume that those are operating in a limited reserves framework. So one of the tools of monetary policy is that the central bank can change the discount rate. Remember that the discount rate is the interest rate that the central bank charges member banks for taking out a loan. They could also change the reserve requirement. The reserve requirement for every demand deposit that is put in, again, a certain percentage has to be put into the required reserves. And the third tool of monetary policy is the open market operations, the buying and selling of government bonds. The goal of monetary policy is through a dual mandate. The central banks are looking for price stability, so they're trying to control inflation, and they're also trying to have full employment. The central bank targets the policy rate through monetary policy. So the policy rate is the interbank lending rate. In the United States, this is known as the federal funds rate, that interest rate that one bank charges another bank for taking out a loan. So that's what monetary policy is targeting when the central banks are using these different tools. Okay, so let's take a look at one of the tools, and this would be increasing the discount rate. What you'll see down here is I've got three different graphs. I've got the money market graph, the loanable funds graph, and the ADAS model. So as we go through what happens with increasing the discount rate, we can look at the different graphs and see the changes that are happening. So when the central bank increases the discount rate, so that would be the interest rate they're charging to member banks for taking out a loan, then that's going to be more expensive to take out a loan. And so the member banks, the commercial banks, they're not going to take out as many loans. And as a result, they're not going to have as much money, or they're going to have a decrease in their excess reserves. If they can't loan out as much money, that is going to decrease the money supply. So we can see that here on the money market graph where the money supply is shifting to the left, and that is increasing the nominal interest rate. When you increase the nominal interest rate, that will decrease interest-sensitive consumption. You'll also have a decrease in the gross private investment. But a decrease in the excess reserves doesn't just affect the money market graph. It also affects the loanable funds graph. And so when there's a decrease in the supply of excess reserves, that means that there's a decrease in the supply of loanable funds. And we see that on the loanable funds graph with that shift to the left of the supply of loanable funds. A decrease to the supply of loanable funds will increase the real interest rate. And this will have the same effect on consumption and investment spending. When you decrease consumption and gross private investment, that will cause a decrease in the aggregate demand, which that draws us over here now to the ADAS model, where you can see that AD is going down. A decrease in AD will decrease the price level, it will decrease real GDP, and it will increase unemployment. Another tool of monetary policy is buying of bonds. Now, the buying of bonds, this is an example of expansionary contractionary policy. The increasing of the discount rate was contractionary monetary policy because you had a decrease in real GDP. So when the central bank buys bonds, they buy bonds from banks. And when they're buying bonds from banks, that is money that will be directly put into the bank's excess reserves. And when you have an increase in the excess reserves, that will increase the money supply. An increase in the money supply will decrease the nominal interest rate, which that interest-sensitive spending on consumption and gross private investment now will go up. It doesn't just change the money supply. It also increases the supply of loanable funds. When you have an increase in the supply of loanable funds, that will decrease the real interest rate, which will also increase consumption and gross private investment. When consumption and investment spending go up, that increases aggregate demand. That causes an increase in the price level, an increase in real GDP. And we can see here all of these on the money market graph, where you have the money supply increasing, causing that decrease in the nominal interest rate. You have it on the loanable funds graph, where you have an increase in the supply of loanable funds, which will cause a decrease in the real interest rate. And you also see it on the ADAS model, when you have an increase in aggregate demand from the increase in consumption and gross private investment. This is expansionary monetary policy because our actual is now greater than the potential, or the natural rate of unemployment. Okay, so we've done the discount rate, we've done the buying of bonds. So the third tool that we have here is decreasing the reserve requirement. When the central banks decrease the reserve requirement, that means that for every demand deposit that's put in, say instead of having to put 20% into the reserve requirement, now they only have to put 10% into the reserve requirement. That gives more money now for the excess reserves. And so you have an increase in the supply of excess reserves. And when there's an increase in the supply of excess reserves, that means that there's an increase in the money supply. Can you pause this video and draw the money market graph showing an increase in the money supply and the impact that it has on the nominal interest rate? An increase in the money supply would decrease the nominal interest rate. And when you decrease the nominal interest rate, that will increase consumption and investment spending. So remember, when you have an increase in the excess reserves, that doesn't just affect the money supply of the money market graph, but it also affects the supply of loanable funds. If you can, stop this video and draw the loanable funds market showing an increase in the supply of loanable funds and the impact that this has on the real interest rate. So when you increase the supply of loanable funds, you will see that this will decrease the real interest rate. And when you decrease the real interest rate, that will increase consumption and gross private investment. An increase in consumption and investment spending is going to increase the aggregate demand curve. So now with our ADAS model, show an increase in aggregate demand and the impact that that will have on price level and real GDP. An increase in aggregate demand will increase the price level, it'll also increase real GDP. So this would be expansionary monetary policy because on that ADAS model, your actual is greater than the natural rate of unemployment. Or another way to say it, this inflationary gap is created because the actual is greater than the potential.